why don't we say how much Roth could we convert in plan for that same $12,000 cost to get much more in that Roth 401k? So we may be able to get 50, 60,000 into the Roth in a given year by doing an in-plan conversion, knowing that instead of putting money into the plan, I'm actually just going to pay a tax.
I mean, that actually strategy can work in situations, yes.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Taxes, taxes, taxes. You know, if we can pay less in taxes, we're always going to be better off. Joining me today on the Guided Retirement Show, Corey Hulstein, Director of Tax here at Modern Wealth, also a CPA, and Marty James, Managing Director of our Indianapolis office, and also a CPA. We're going to talk about tax planning tips for you. Enjoy my conversation with Corey Hulstein and Marty James. All right, Corey Hulstein, Director of Tax, CPA. Welcome to the Guided Retirement Show.
Yeah, thanks for having me, Dean.
And we also have Marty James, Managing Director of our Indianapolis office. Welcome to the Guided Retirement Show, guys, both of you.
Glad to be here.
All right, so we're going to talk about tax planning tips here. And as we begin to talk about tax planning tips, I want to set the stage and really help people understand that a CPA is only going to be able to do tax planning to the extent that they actually fully understand your total financial picture. And most CPAs do not understand a person's total financial picture because most CPAs are not certified financial planners, which is why here at Modern Wealth, we have our certified financial planners actually working with our clients and prospective clients, preparing the financial plan. And then you, as the CPAs here and your team, you step in and then you look at that financial plan from a tax perspective, asking the question, how can this individual pay as little tax as possible over their lifetime? And Marty, I know that you've been in this game for a long time and you understand the power of tax planning over tax preparation. So talk a little bit about your look at tax planning versus tax preparation.
Yeah, so it's two different mindsets. So when you're doing the tax return stuff, that's tax compliance. And any tax planning you're doing while you're doing the tax return is what I call triage planning. You're just, the game's over and you're just trying to figure out if there's anything else you can do. Tax planning is more proactive, and rather as opposed to calling it tax planning, it's almost tax management, which is something you're doing throughout the year. So they're two totally different mindsets.
Now, Corey, I know that if you had your choice of doing a tax return or doing tax planning, you much prefer the tax planning side. Why is that?
Yeah, I think that's where we can actually make a difference for people. To Marty's point, when you're looking at a tax return, A, it doesn't give a true financial scope of what these people have, but B, it's also limited opportunities of what you can do. Everything's already expired besides a few items remaining. Things like HSA contributions, IRA contributions, but beyond that, we're kind of stuck. When you're talking about tax planning, you're looking at a 3, 5, 10-year horizon, which gives you a lot more opportunity to actually make an impact for the clients.
So you might be thinking about something that might need to be done in 2 or 3 or 4 years, and then doing the work far ahead of time to make sure that you've done everything right.
Yeah, I mean, asset allocation is a big part of how we do that. This creates the flexibility in order to actually move the puzzle pieces around to make things fit appropriately.
So, Marty, one of the things that I know is very important in tax planning is bracket management. And, you as a CPA saying bracket management, that means something to you. Why don't you explain to our listeners and viewers what is it that bracket management actually means?
So we have a progressive tax system that, could be 0, 10, 12, 22, 24, on up to the top of 37 right now. So what it means is not every dollar that I earn is taxed at that highest marginal bracket that I'm in. So if I'm in a 24% bracket, not all my dollars are being taxed at 24%. But that next dollar, that marginal dollar, will be taxed at that 24%. So the idea is, how much room do I have left in that bracket that I think I'm going to be in a long-term basis? So if I'm in a 12% bracket right now, if I'm not really doing any planning, but we roll around to 2027, RMDs kick in. Now I'm going to be in a 25% bracket or 28% bracket. That's not efficient use of your tax brackets, where you really need to kind of probably go up on into that 24% bracket, especially if it's going to be the 28% bracket. And that's where, a lot of your strategies, where you're doing your Roth conversion, to bounce that up. Obviously, there's a lot of other factors that can come into play, but that's the general concept.
Hey, Corey, you want to add anything there?
Yeah, the way I say this to a lot of people, Marty, is we want to smooth these brackets over time. We don't want peaks, we don't want valleys, right? We want a straight line across the board through retirement. That's where we're going to see the efficiencies through the tax planning.
When you guys are doing bracket management, is it easy for you to illustrate the long-term tax savings for people?
Not really, no, because yes and no, right? They're the obvious ones of, to Marty's point, if we can take money out at 12% today and we know it's going to be 28% in 5 years, that's a very easy concept. The part that gets difficult is, what is the performance of the accounts, right? How do you measure the cost opportunity if we had to give up tax dollars today? That's a trade-off because those dollars aren't growing now in the future, right? So there's a lot of elements involved here of how long do we live? Do both spouses live for a long duration of time? What is the performance of the accounts? Have we properly allocated the accounts with proper investments based on where they're located?
So what you're talking about there, Corey, is really, you're just amplifying the importance of the CFP working with the CPA, because if you're not on the same page and you're both not, going after the same objective, that's where things can get missed.
The left hand has to know what the right hand's doing.
Absolutely. Marty, there's another thing that happens, and this is all part of the Affordable Care Act, ACA, also known as Obamacare, which is the 3.8% net investment tax. So it's a surtax on investment earnings. And one of the things that you do as far as tax planning is saying, how do we minimize or potentially even eliminate that 3.8% surtax?
Yeah. So when this came in, it was part of the whole Obamacare thing. But when you hit certain levels, say a married couple, they have, $250,000 of modified adjusted gross income. Now that 3.8% net tax will kick in. So you're always, cognizant of that as you're doing the bracket bumping strategy. You say, okay, well, maybe I don't want to do that. Another factor, in that is also like your Medicare IRMA charges. Maybe it makes sense for me to go up to the 24% bracket, way up. But because of the IRMA, maybe I don't want to do that. Maybe I just want to make that IRMA level my top threshold of where my income needs to be. Which is going to protect me obviously from the 3.8.
Okay, Corey, Marty used one of those acronyms that CPAs and CFPs like to use, IRMA. Explain that really quickly so people don't get lost.
Yeah, in jest, IRMA is our good friend, right? Income-related Medicare annual adjustment is what IRMA stands for. And essentially the way that works is the higher your income goes, they're going to charge you more for the Medicare premiums. The way I refer to this is a shadow tax. You don't see it for 2 years. You don't really feel it. All of a sudden you get a bill in the mail and, oh, hey, here we go. For the next 12 months, our Medicare premiums are substantially more than they were in the prior year.
So it's a 2-year look back at your income 2 years ago is how they're going to determine whether or not you should be paying more for Medicare.
Yep, and it's a cliff system. So you have to be extremely careful because if you go $1 over their threshold, it can cost up to $2,000 to $3,000 depending on if you're single, married, or what tier you're bumping into.
That's pretty expensive tax.
Yeah, no, not a super effective rate there.
Yeah, and for married couples, remember it's times 2.
Oh yeah, so it's even worse. So people can make a mistake there by, they wanted to buy a new car and they decide, well, I'm just going to take the money out of my IRA and buy that new car, and they don't think about that potential IRMA tax. Yes, they know that I'm going to have to pay taxes on my distribution, but it may cause more Social Security to become taxable, may bump them up into that next IRMA. So people really got to look at, where they're pulling their money from. And you guys have a term you call income shifting. And I don't know exactly when you think about income shifting what you mean, but you may want to take more one year from one type of an account and less another year. Talk a little bit about that, and I'll let Corey go first on this one.
Yeah, so I think the way I would refer to that is where are we funding the source from, right? So are we taking money from a non-qualified account that's going to have a significantly different taxation than taking funds from an IRA account? So how are we staggering these distributions, right? So the car example, if we have non-qualified funds available, that's going to result in a lower taxation, generally speaking, than an IRA distribution. So that is a possible avenue we go down. But at some point in time, you have to be able to bounce back and forth between the two. You can't just simply always spend from a non-qualified account.
And Marty, one of the things I think that we see happening oftentimes, and I think the way that people are thinking about this is, people that have got money in a Roth IRA, they for some reason have this mindset that I should never touch that Roth IRA, but having that Roth IRA as you enter into retirement can really be a great bracket management tool. Hiding some of these shadow taxes, as Corey referred to it, or even lowering that tax on Social Security. So talk a little bit about potentially spending out of that Roth IRA in retirement, where most people go to the mindset is I'm never going to touch that, and that's what I'm going to leave to my kids.
Yeah, and a lot of people, if it's the legacy plannings they're worried about, that's what they're going to do. But we use it more often than not is as we're bracket bumping and getting that money into the Roth. I'm telling the client that, hey, we're just creating a tax-free pool of money that you can draw on whenever we need to, so we don't blow up your tax bracket in the future. So when that vehicle, would show up, we can access that. Or even if we've got enough money in the Roth, back to Corey's point, as far as smoothing out your tax bracket and your taxes throughout retirement, we can access a combination of Roth and then pre-tax money. So it's just a great tool. It's a great investment vehicle, not investment, but a tax vehicle, to have.
Yeah, and the thing I'll add there is each account serves multiple purposes. We don't have just one agenda for each one of these account types. So one of the purposes for that Roth IRA is, I refer to it as a get out of jail free card. Something in life happened, and the cost of that is going to be significant through taxation if we don't utilize this Roth account. That's a perfect time to utilize it, right? We moved that money over to a Roth at a cheaper rate than what we have today. That's a win. We don't want to do that all of the time, right? But it is a great get out of jail free card when we're in a bind.
So getting money into a Roth IRA is part of tax planning, right? And so you can either make a contribution to a Roth if your income limits aren't too high. You can always put money into a Roth 401k. Now there's the potential for the company match to go into the Roth portion of the 401k, but then there's also Roth conversions, and Roth conversions allow you to take big sums of money out of your traditional IRA or traditional 401k and convert that over to a Roth IRA where you pay the tax when that conversion is made, but then forevermore, that account is tax-free as long as the earnings have had at least 5 years to grow. You can always pull out whatever you contribute to convert, but you got to have that 5-year period, and you have to have attained age 59 and a half. So, Marty, when you're thinking about Roth conversions, and we'll get to Corey here in a second, but when you're thinking about Roth conversions while somebody is working in their last few years versus doing those Roth conversions after they've retired, is there a steadfast rule on should you do it while you're working or should you do it after you retire, or does it depend?
No, there's not. It depends. That's the answer. It depends. And that goes back to the financial plan, as you're looking at what retirement cash flows are going to look like and such, and we kind of have a good idea of what that taxable income is going to be. That's what we're measuring against. Now, there's factors like, I'm retiring early, pre-Medicare, and I'm going to access, the ACA system for my health insurance. Well, maybe I could do like a larger Roth conversion before I retire, access that money to keep my income low so I get the maximum tax credits, out of that system, the premium tax credits.
Corey, what about you when you think about converting pre or post retirement? What are your thoughts?
Same exact answer. It depends. And that's always the CPA answer, right? The key there is to not operate in a vacuum. right? Someone with $300,000 of W-2 type income today might not feel like a fit for a Roth conversion. Well, if you look at the financial plan, and to Marty's example earlier, we're bumping to 28, we're bumping to 32 when RMDs start. That actually is an excellent time to do conversions. Today, we can have about $400,000 as a married couple and still be in the 24% tax bracket and likely not subject to IRMA since we're working. So it very much depends. It's important to have both views of things, both from the tax side of things, but also that financial plan to make sure we're dialing that in appropriately.
All right, perfect. So let's move on to trust planning and a couple of different things you can do. Charitable remainder trust versus a charitable lead trust. I'll let you, Corey, take the charitable remainder trust and when that might be appropriate for planning, and then we'll turn to Marty for the charitable lead trust.
Yeah, so a charitable remainder trust might be appropriate for someone who wants to give a large sum of money today, right? But also might still want to be able to access some of those funds. So a charitable remainder trust, basically what you do is you put money into the trust today. You get a present value deduction based on when the charity is going to receive the money. So if it's 10 years, that's going to look a lot different than if the charity receives the money in 20 years, because that's going to minimize that fair market value calculation or present value calculation. It also allows you to take some income stream off of those invested assets that you donated up to the point of completion of that trust.
And then the opposite of that, Marty, is the charitable lead trust. So talk a little bit about when that might be appropriate.
Right. So those really come in like two different flavors. One is where I get a tax deduction, and another one's when I don't, when I fund it. But essentially what's happening is I take a certain amount of my assets and it's going into this charitable lead trust. Okay. So the interest income on that in one form of it comes back to me where I pay taxes on it, but I did generate income tax deduction up front. So that's how that works. On the other flavor, all the income goes, but I didn't get a tax deduction up front. And ultimately, the money does come back at the end of that term of that charitable lead trust. The money comes back, to me or to my heirs.
Okay, so you guys, if you're doing the planning and the CFP's done the work, you're going to be able to look at this if there are charitable intentions and guide people on how to most effectively do that.
Yeah, and I would say on both of these topics, they're less appealing today just due to the estate exemptions. So today we'd probably prefer, potentially a donor advised fund where your horizon's a little bit shorter than either one of these trusts. QCDs are going to be great options as well. So again, it's going to depend on the situation. Generally speaking, any type of trust is going to be a higher level of asset value.
And would you use these charitable remainder trust or charitable lead trust as a way to potentially do a larger Roth conversion early in retirement?
You could, but one of the key things is, you need to be really charitably inclined for this really to make sense in most cases. But yes, you could.
Let's talk about maximizing retirement plan contributions. I've been in this industry for 37 years, and sometimes I see people, what I would say they're over contributing. So saying maximizing those retirement plan contributions may not be the right thing. I've even seen scenarios where, hey, let's only put into our company plan up to the match, and the rest that we would be contributing, let's use that money to pay for some in-plan Roth conversions to build a bigger Roth nest egg than just going ahead and making those contributions to the Roth portion of the 401k. Corey, I'll let you tackle that first.
Yeah. I think a lot of it comes down to what kind of flexibility do we have on the current asset location, right? If we need to create more flexibility with the plan, that's a great time to start paring back some of those pre-tax contributions in, right? To, again, maximize conversions today, right? Getting more money over to the Roth or even to a non-qualified account is a great example as well, just to create flexibility where we don't have to tap into the Roth. But that's something we work with people on as well, is just even paring back the contributions, still getting the match, but even just saving that money into a non-qualified account can be an effective strategy.
So Marty, let's talk about this from the CFP and CPA working together perspective here. If I am in my mid-50s, I'm planning on retiring in my mid 60s, and it's clear that I've got enough that I've saved. Does it make more sense to max out that Roth contribution? Or let me just give you some fictitious numbers here. Let's just say that I am maxing out my plan, and that maxed out plan is $24,000 a year, but the company's only matching up to, say, the first 12. So that second $12,000 that goes into the plan, it might be going into the Roth portion of the 401k, but that's only $12,000 a year getting into the 401k. Instead of doing that, why don't we say how much Roth could we convert in plan for that same $12,000 cost to get much more in that Roth 401k? So we may be able to get 50, 60,000 into the Roth in a given year by doing an in-plan conversion, knowing that instead of putting money into the plan, I'm actually just going to pay a tax.
Yeah, I mean, that is a total, I mean, that actually strategy can work in situations, yes. Because, I mean, you're just magnifying the amount of money that's going into that Roth. Because what you have to remember, the tax in there is really a loan from the government. Every time I put a pre-tax thing in there, it's a loan to the government. They're going to want their money back with earnings. You know, it's like we went into the bank to borrow money under these terms, we would just walk out. We wouldn't do it. So, but yeah, that strategy is something that you definitely need to, weigh that into the financial plan, see what it looks like.
Yeah, so you got to take both of those strategies and say, which one gives me the highest probability of success, depending upon my view of success, right? So this is why it's come down to each individual, and this is why it's important to have that CFP do the planning work up front so that you guys, from a tax perspective, can come in and help this client make the best decisions.
Yeah, absolutely. And again, both sides of the house, you need a view on both sides of that house. What's important to this client? What are we trying to achieve? Is it legacy? Is it maximizing our retirement? Is it travel? What are these things? Because all of those things have a different need for cash flow and a different need for taxation.
Okay, let's go to someone who might be a business owner. They may have a property to sell. They may have some farmland that they want to sell, something that's going to be sold. And there is a Code Section 453 deferred installment sale that someone might want to consider. And Marty, I'll let you tackle that deferred installment sale, and then Corey can add whatever.
So let's say I have some farm ground and I'm going to sell it. My choices are obviously I'm going to get cash, and then I'm going to pay taxes on the entire capital gain, all once in 1 year. The other option is actually where I'm going to be the bank, and I'm going to hold the paper for the person buying this, and they're just going to be paying me every year until that contract, is ballooned or done, depending on how amortization works on it. But so a component of each one of the payments I receive will be principal on that note, and part of it will be interest. Now, when I sell that property, we've calculated what the gross profit percentage on that is. So say out of that principal, 60% of it is capital gains and 60% of it, and 40% of it is my basis. So I'm literally stretching my taxes out over a longer period of time, which can help me with in certain situations with the NIT tax. Now with businesses, typically we don't have to worry about that so much, but anything that would be subject to the NIT, maybe I can avoid that by keeping myself under that. And also going back to Corey's point, as far as smoothing out my tax brackets, and avoiding potentially, higher Medicare premiums. So there's a lot of reasons to do it. And the risk is, I'm the bank. So you have to go through the same procedures that any bank would do if you're going to do that.
Okay, thank you. Corey, anything you want to add there on the installment sale?
Yeah, the thing, the thing I would add is there are two components of each payment you receive. So if you have a 5-year note and you're getting $100,000 a year on that note, there is a portion of that $100,000 that is actually interest. That interest component is always ordinary income. The other portion goes to that gross profit percentage, and that is going to be capital gain income. But Marty hit it on the head. It's smoothing your tax brackets out over a duration of time rather than absorbing at 20% capital gain plus net investment income tax. There might be an avenue that we can get this money out at 15% and potentially no net investment income tax.
Okay, perfect. Let's cap this off, guys, by talking about tax efficient investing. And I've got two components here. We talked about the Roth. Obviously, that's the most tax efficient you can get. It's tax free, right? But there's another tax free investment out there, and it is municipal bonds. And then you got tax efficient equity investing, which is done through something called direct indexing. So, Marty, since you're a little older and you've been around a little bit longer than Corey, I'm going to throw the tax-free investing to you on the municipal bonds. There's opportunities in today's environment that we have in municipal bonds that we haven't seen in probably almost 20 years. So I'll let you tackle that one first, and I'll let Corey do the direct indexing.
So one of the things that, I don't always necessarily like to have the whole tax stuff wag the tail on the investment side of it. You hear that all the time. So obviously, it's looking at the investment side of it first. Then what can we do to make the taxes work? And you're right. Over the just until about 2 years ago, it was really hard to really justify some of the municipal bond interest rates because we were getting zero and everything else also. But now, where interest rates are, you can get a really good yield, tax-free. In addition to that, if interest rates do fall, say we have, go to this recession that everyone says is supposed to show up eventually, interest rates typically fall in that environment. Those bonds will appreciate, which gives you the opportunity to actually have, capital gains, on your bonds.
Okay. Yep. And I agree. It's the first time in almost 20 years that I've been excited about that particular type of investment. Corey, you got the equity market that's out there, and probably the most inefficient way in a taxable account to invest in equities is in an equity mutual fund followed by an equity ETF. But we have this evolution of something called direct indexing, which basically takes the wrapper off of the mutual fund or the ETF and allows the investor to establish their own cost basis in each individual share, making that much more tax efficient. So I want your thoughts on direct indexing.
Yeah, direct indexing is a great model for us now to get more tax efficient in the equity market. It's a little bit of a hybrid of both an ETF and a mutual fund in the sense that it can be actively managed, but you're not fighting the capital gain distributions from a mutual fund. So you're evolving, you're moving in and out of positions continuously, but you're harvesting losses and getting back into a similar position that has the same upside growth potential. So what's happening is you're generating these short-term losses today to offset any gains that you want to take out in the future here. So it's an actively managed strategy that's accelerating some losses, not at your detriment, but actually just to create the tax efficiencies of accelerating those losses today.
Right. So I want to make sure that everybody's clear when we're talking about tax loss harvesting. That's the strategy here. You're not talking about your account actually losing money. You're talking about taking one of the equities that might be in the portfolio that's at a loss today. Let's use an example, Coca-Cola. It's at a loss. Let's sell Coca-Cola. Let's turn around and buy Pepsi. And then we reestablish a new basis and we get that tax loss that will carry forward on our tax return unless we have other capital gains that can offset.
Right. And 2023 is a great example, right? We talked about the Magnificent Seven a lot in 2023. So out of the S&P 500, there was about 7 companies that was really driving that growth. That means you've got 493 companies there that aren't really doing that much for you, right? So how do we take some of those 493, accelerate some of those deductions today, but still keep that upward growth potential going by investing in a similar company there?
Perfect example. Gentlemen, I know, Marty, you want to add something on the direct indexing?
Yeah, I do. I want to add to, let's say somebody has recognized the gain on an outside transaction from their brokerage account, and then you take some of those proceeds, you put them in a direct indexing situation, and you tell them, well, my capital gain budget is zero. I really want to show a loss by the end of the year. I can offset some of those losses. Those losses can offset some of those gains from that transaction I had outside.
Well, I know that we've covered a lot of material here in just under 30 minutes. I appreciate both of you taking the time to join me here on the Guided Retirement Show. I think it's super powerful that here at Modern Wealth, we've got a team of really qualified CPAs working alongside our CFPs to not just create a great financial plan, but to also create great tax outcomes. And that adds so much to an individual situation. So thanks to both of you for being here.
Yeah, appreciate it, Dean.
All right.
Thanks again for joining us here on the Guided Retirement Show. I'm your host, Dean Barber. Special thanks again to Corey Hulstein and Marty James.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.